All right, welcome. Today, we're going to do a strategic deep dive into one of the most powerful and honestly, most misunderstood tools in finance, the tax credit. Now, I want you to forget what you think you know about tax breaks for a minute. We're going to give you a framework to see your taxes not as this thing you have to do, but as a strategic landscape, one that's full of opportunity. Okay, let's get into it.
So let's just cut right to the chase. If I asked you, what is the single most powerful lever you can pull to directly, and I mean directly, reduce the amount of cash you send to the government, what would you say? You might think, oh, finding more deductions or maybe maxing out my 401k. And look, those things are super important, but they are not the most potent tool in the toolbox. The answer, which we are going to prove today, is the tax credit. And here's why. It's actually pretty simple. A tax deduction, it's good. It lowers your taxable income. But a tax credit is great because it lowers your actual tax bill, dollar for dollar. You know, it's kind of like the difference between getting a coupon for 20% off an item versus getting a $20 bill handed to you at the register after you pay. One reduces the number you start with, the other directly reduces the final amount you owe. And trust me, that distinction, well, that's the whole game.
So to really break this down, we're going to follow a really clear, structured roadmap. First, we'll establish the fundamental advantage, why credits win. Then we'll give you a MECE framework for understanding the three types of credits. After that, we'll see these credits in action in a simple scenario. Then we'll get to the credit versus deduction showdown with the hard data. And finally, we'll look at policy in motion, because this stuff is always changing. Okay, let's kick things off with the core principle. Why is a credit just so much more valuable? It really all comes down to some very simple, direct math. This isn't about finding some crazy loophole. It's just about understanding the basic mechanics of how your tax bill gets calculated. The key phrase here, the thing you have to remember, is dollar for dollar. That is the golden rule of tax credits. Every single dollar of a credit you get is one less dollar you have to pay in taxes. It's a direct one-to-one swap. There's no fancy math, no percentage taken off. It's just a pure, straight-up subtraction from your final bill. And this just lays it out perfectly. A deduction's power is always limited by your tax bracket. So if you're in the 22% bracket, a $1,000 deduction only saves you $220. The other $780, yeah, that's still getting taxed. But a $1,000 credit, that saves you the full $1,000. The credit is almost 5 times more powerful in this case. It's huge. So think of it this way. Deductions kind of chip away at your income, but credits, they take a sledgehammer to your final tax bill.
Okay, so we've established why credits are so powerful. Now let's build a framework for understanding what they are. Using a classic consultant's approach, we can categorize every single tax credit into a MECE framework. That just stands for mutually exclusive and collectively exhaustive. It's a fancy way of saying every credit fits into one and only one of these 3 buckets, no overlaps, no gaps. And here they are. The 3 categories are non-refundable, refundable, and the hybrid, partially refundable. I guarantee if you can get your head around how these 3 types work, you understand the entire universe of tax credits. So let's double-click on each one.
First up, the non-refundable credit. Now, think of this as a powerful tool, but a limited one. It can completely wipe out your tax bill, taking it all the way down to 0, which is awesome. But, and this is the big but, it stops there. So if your tax bill is $2,000 and you have a $2,500 non-refundable credit, it'll zero out your bill. But that extra $500 of credit, it just disappears. Poof, gone. It's a real use it or lose it situation. And you see these all over the place. The adoption credit, the lifetime learning credit for educational stuff, the child independent care credit. These are all classic examples. They're basically designed to help you offset specific costs by lowering your tax burden, but they won't give you a direct payout beyond what you actually owe. All right, now we get to the second type, refundable credits. And honestly, these are the gold standard. A refundable credit does not care what your tax liability is. It doesn't care if it's $1,000 or 0. It'll first wipe out any taxes you owe, and if there's any credit left over, the government actually sends it to you as a check or a direct deposit. It's not just a tax break. It can literally be a cash payment from the government to you. Probably the most famous example is the Earned Income Tax Credit, or EITC, which is there to help low to moderate income workers. Another big one is the Premium Tax Credit that helps with health insurance premiums. These are so powerful because they're not just tax relief. They really function as a form of income support. And finally, our third bucket is the hybrid model, the partially refundable credit. And just like the name says, it's a mix of the first two. Part of it acts like a non-refundable credit. It can only zero out your tax bill. But then another portion of it is refundable, which means you can get some of that excess back as cash. But usually there's a limit. The classic example here is the American Opportunity Tax Credit for college students. It's a credit worth up to $2,500. So after it zeroes out your tax bill, you can still get up to 40% of whatever's left back as a refund, but it's capped at $1,000. See it? It has that non-refundable part and then a capped refundable part. A true hybrid. All right, we've covered the theory, we've got our MECE framework down. Now let's make this real. We're going to run a super simple scenario to see exactly how these different credit types play out with actual numbers. Okay, so imagine your final tax bill for the year is $2,000, and you qualify for a $2,500 tax credit. Now, if that credit is non-refundable, it wipes out your $2,000 bill. That's great. You owe nothing. But that extra $500 of credit value, it's just lost. Now, what if that same $2,500 credit is refundable? Well, it first wipes out your $2,000 bill, and then the IRS sends you a check for the remaining $500. Same credit, same tax bill, but a $500 difference right in your pocket. This is exactly why knowing the type of credit is so critical. And now for the main event. We started with this thesis that credits are way more powerful than deductions. We've explained the logic, but now it's time to prove it with a head-to-head comparison using a really clear data-driven example. The question couldn't be simpler. You have a choice, a $5,000 credit or a $5,000 deduction. You know, on the surface, they've got the same number attached to them. But as we are about to see, the financial outcomes, they are worlds apart. Okay, let's walk through this table together. On both sides, we're starting with the same income of $75,000. Now look at the deduction column on the right. The $5,000 is subtracted first, right at the top. That brings your taxable income down to $70,000. Apply a 22% tax rate, and you get a final tax bill of $15,400. Got it? Okay, now look left, to the credit column. Your taxable income stays at $75,000. The 22% tax is calculated on that full amount, which gives you a pre-credit tax bill of $16,500. Then, at the very end, we subtract the $5,000 credit directly from that bill, bringing your final taxes down to just $11,500. So let's just focus on the bottom line. The taxes you owe with a credit are $11,500. The taxes you owe with a deduction are $15,400. That is a $3,900 difference. In this scenario, the $5,000 credit put $3,900 more back in your pocket than the $5,000 deduction. This isn't an opinion, it's just the math. The data is absolutely unequivocal. And that brings us to our final section. Because it would be a huge mistake to see any of this as static information. The world of tax credits is not set in stone. It is a dynamic landscape that is constantly being shaped by government policy. And staying on top of these shifts is a key part of any good financial strategy. And the child tax credit is the perfect case study for this. It started out as non-refundable. Then the Tax Cuts and Jobs Act made it partially refundable. Then, just for 2021, the American Rescue Plan came along and temporarily made it fully refundable and way bigger. But then it snapped right back. This one credit has literally shifted across all three of our MECE categories in just a few short years. It just goes to show you that legislation can totally change the value and the mechanics of these tools, creating huge opportunities or closing old ones overnight. So let's bring it all home with the one sentence that really captures the core of this entire explainer. This is the fundamental distinction that drives everything we've talked about. Credits directly attack the tax you owe. Deductions only reduce the income on which you are taxed. Always, always remember that hierarchy of power. And that leaves us with one final question for you to think about. This isn't just about filing taxes for last year. It's about planning for next year and the year after that. Understanding this framework, credits versus deductions, and knowing that the rules are always in motion, that's step one. The real challenge is to stay informed and stay agile. So how will you make sure your financial strategy is built to capitalize on these powerful but ever-changing tools?